Okay, so we're just about at 8 o'clock, and I started things a little early on the off chance that there were tech issues, which thankfully have not materialized. On the off chance that. There we go. So that's a good thing. So as we let people filter in closer to 8 o'clock, I thank everyone who's already joined me. And look forward to having a few more people join on. This generated a fair bit of interest, which I was very happy to see, excited about. And obviously there's a lot to talk about right now with interest rates. And so I'm looking forward to kind of having this session and kind of reviewing things with everybody, because it's a unique time, that's for sure. So, all right, getting close to 8. How's everybody doing, by the way? Feel free to, for those of you who are in here, you can add comments, ask questions, and I will do my best to get to them as they pop up. But if it's something that I'm going to be covering in a little bit later on, it's not that I'm ignoring you. It's that, it is a topic matter we'll be covering. So feel free. I'm going to try and monitor the questions as best as I can and address them as we go. So it looks like we're now at the 8 o'clock point. So I'm going to kind of get the ball rolling, and we'll let everybody else filter in. So thank you everyone for joining me. In case you didn't know, which would be weird because you're on my Facebook page, I am Jamie Vasey, known as the Mortgage Jedi, and doing mortgages, not just, I used to say, KW Guelph and all over Ontario. It's now all over Canada, thanks to a new central underwriting process. So I now have the ability, to actually help people all across the country. And thank you, Amanda. I am very, very, yes, I did decorate the office myself with the baseball art, for those who asked. So we will be talking tonight about the interest rate situation and kind of what's going on, what's contributing to it, why things are happening the way they're happening. It's going to focus primarily on variable rate mortgages and variable interest rate, because that seems to be what's causing the most amount of miscommunication, misinformation, and anxiety for people. Fixed rate, just as kind of a quick talking point to begin with, there's a difference between what influences fixed rate and what influences variable rate. So the two things, while they are connected, they're influenced by very different things. Fixed rates are influenced by the bond market, whereas variable rates are tied directly to the Bank of Canada overnight rate. And that's the thing that we want to focus on, because we know there's another rate announcement coming on Wednesday, a week from today. And, it's expected that the Bank of Canada will follow suit to the US and actually raise things by 75 basis points, or 0.75%. I'm still holding out hope that maybe they sit there and say, okay, we'll do 0.5%. And then people will just go, at least it wasn't as high as the US. But we'll see. But the important thing is to take away from this, I want to talk about, really, I want to answer 3 different questions for people that I hear a lot. And one of them is, should I have gone with a fixed rate mortgage instead? One of them is, how high can rates go? And then the third is, what happens if I get into a situation where my mortgage is no longer affordable, which we are, by the way, a very far way from, and I'll explain that as we go through. But I also want to address a lot of, as I said, the misinformation and the anxiety that we see around the interest rates right now. And we're going to do that by focusing on facts and data and not headlines. I think it's important for people to remember that there used to be a time back when newsprint was the big thing and how we got our information, where headlines were actually a good synopsis of what the rest of the article entailed. Now, in the digital world, headlines are meant as clickbait and nothing more. They don't necessarily really reflect it. They're not a true reflection of what's in the article. They're meant to get you to click. And that's important, because a lot of us do consume our information via headline, not through other means. And that can cause a lot of misinformation to be out there. So I want to focus on the facts and the data and what that tells us, which I'm going to try and do in a way that's really understandable, really digestible, and really relatable for you. The other thing is, it's important to understand that when we talk about the Bank of Canada overnight lending rate, which does influence your mortgage rate, it also influences other things. And that's the piece that sometimes gets forgotten, that it influences your line of credit rate, it influences loan rates, things like that. There are a lot of different types of borrowing that are tied to that rate. In other words, it doesn't just influence home debt, it also influences consumer debt. And that's a very important distinction because it's part of what's driving what's happening. So let's just start with what is happening. And what is happening is being presented in maybe a false way. Everybody who went with variable rate mortgage did so making the decision with the information they were presented at the time, and was smart to do so. Now, the interest rate, or the information being presented at the time, I want to take everybody back a little bit. In September of last year, the Bank of Canada did their rate announcement, and they said, they targeted quantitative easing to kind of offset that 2% inflation mark to start at the end of 2022. Okay. So anybody who was looking at what the Bank of Canada was saying said, okay, we anticipate rates are going to start creeping up at the end of 2022. Then in October, they did their rate announcement, and they still held things still. And they said, but we think with that 2% inflation rate is going to actually come to fruition sometime in the summer. It's going to be the middle 2 quarters. So then we were anticipating, okay, we're going to start to say quantitative easing, which is a way of saying raising interest rates gradually, spring, summer, fall type thing. And then in January, the Bank of Canada still held rates steady, but inflation was still what we're going to call out of control. And quantitative easing had to happen sooner than later. Now, if we go back to March of 2020, okay, just before the pandemic, interest rates right now are still lower than where they were before the pandemic. The overnight lending rate is lower than where it was then. Fixed rates are way up compared to that. But the overnight lending rate is lower than where it was just before the pandemic hit. And the Bank of Canada, in a 3 to 4 week span, dropped that interest rate by 1.5% rapidly, like it plummeted down, historically never done before. And so they knew that they were going to return to that normal, because prior to the pandemic, it was trending upward. We knew that. So what we've seen is a return to normal, just at an escalated pace, much quicker than they thought was going to happen, because their anticipation, and the Bank of Canada's anticipation, is when interest rates go up, people slow down their spending habits. And that hasn't happened. People's spending has not slowed down. So let's talk about that piece a little bit. We know that what's happening is the Bank of Canada, by trying to raise rates, they're trying to stem the inflation. We all see inflation. We all see how it's impacting us. Gas prices were up, food prices were up. If you try and take a trip now, you see hotels are more expensive. Everything is like, and that's the result of more money being out there. People are spending more, which means the costs of things go up. To isolate it to the housing market, when more people were trying to buy houses, the price of houses went up. That was happening across the board with everything. But what was also happening is, in the face of a pandemic, people didn't stop their spending habits. They shifted them. So the government believed what was going to happen was, okay, people aren't going to go on vacation. They're not going to be able to. They're not going to go to concerts or sporting events or go out to restaurants or movies. So they're not going to be able to spend. And so somehow we have to figure out a way to, stimulate the economy to get them to spend. Well, people found a way. They were on Amazon. They were going nuts on Amazon. They were doing Uber Eats. They were finding all these ways to still spend that money. Now, some people, a good number of Canadians, and keep in mind, when I'm talking about this, I'm addressing the Bank of Canada, right? So that means they're taking data from across the country. It's easy for us to look at Southwestern Ontario, and think that this is a GTA thing or a Guelph or KW or whatever, or a GVA or whatever. We're talking about data from across Canada. So when I say this is the data they were seeing, that's Canada-wide. It may not feel like it for your own individual situation or for what you're hearing from friends and family, but Canada on a whole. So people were still spending, okay? People were, sitting at home and they're like, okay, well, I can't do all these things that I think are fun. But I'm going to sit there on Amazon, and normally I wouldn't bother spending $50 on a sweater for my cat, but I've got extra money now because I'm not going on vacation. So I'm going to buy a sweater for my cat. That spending hasn't changed. So now things have opened up and people are going to sporting events and they are going to concerts and they are going on vacation and all of these things, but they're still buying the sweaters for their cats, which in the face of interest rates going up, so like gas is costing more, food's costing more, your home is costing you more, but you're normally in those situations, historically, people have then said, okay, if all of this stuff is costing me more, it means I'm going to spend less on, the things like trips or going out to events or restaurants or things like that. That's how inflation stays balanced. But we haven't done that, and it's kind of been what I call a defiant spending, because we were been told for 2 years, hey, you can't go to concerts, hey, you can't travel, you can't do this. And now we want to, and rightfully so, we missed out on this for 2 years. But now we've got rising costs of it. And instead of saying, okay, well, my bank account says I shouldn't be doing this, we're like, yeah, but I've had to go without for 2 years, so I'm going to do it anyways. And we haven't shifted that spending away from other areas that we started spending it on. So, as on a whole, this is what's causing the inflation to stay high, and the result is a rapid return to normal with the interest rates. Now that's kind of a big, boring picture of what's culminated in where we are now. So if you're sitting in a variable rate mortgage, and good for you if you are, the question is, should I have gone fixed instead of variable? Well, here's the interesting thing. The short answer is no. The slightly less short answer is we're not going to know for another year and a half. The short answer is no, because right now, as we sit, okay, you made a smart decision based on the information that was out there at the time, right? Everybody did it with a cushion of, anywhere from 1.25% to 1.5% difference. Sorry, my headphones are wanting to fall out, between the variable rate and the fixed rate at the time. Now you've enjoyed a year to a year and a half or whatever of savings, that it's easy to forget that. It's easy to forget that, yes, you've been paying that mortgage payment, but that was less than had you gone fixed. You were paying less for over a year. And now that interest rate has gone up, you're paying more or about the same as where you would have been, but on a lesser amount. So you're still further ahead financially. Now, if you were to switch to a fixed rate, you're automatically locking in at over 5%, right? Which, if you think about it, you're forcing yourself to take a huge increase in your payments. And we're really getting close to where everybody's going to start feeling it. And we're starting to see signs of the downturn. So we're seeing gas prices come down, for example, and things like that. And it's kind of one of those things where it's like, okay, are we near an apex where, like a lot of the people in the industry I'm talking to, we're expecting that the back half of the year is now where it starts to come back down and make a little bit more sense. So you're not going to really know how far ahead you are until we've seen, okay, we've just seen how much time you had with the lower rate. How much time are we going to have with this, higher rate? And that's when we see how has it balanced out over time, and what was the right thing to do. Historically, over the last 30 years, it's been variable. Variable's usually been a wave like this, right? It's like it goes up, it comes down, it goes up, it comes down, and it happens gradually over time. It's like a slow moving process, so that when a 0.25% happens, you usually don't see another 0.25% increase for like 6, 8, 9 months. And so those little increments, you don't feel them, right? Because you'll have various different things like pay increases and stuff like that. What's happened this time around is more of a roller coaster where rates were creeping up, and we hit March of 2020 with the pandemic, and it went whoa, and now we're creeping up. Only instead of creeping, it's gone right back up. So to switch now means kind of like you're buying a stock when it's high, and that you rarely do well when you buy a stock when it's high. So keep that in mind. The other interesting thing about this is when people ask, should I lock in? Should I lock into a fixed rate? It's the Bank of Canada looks at this and says, okay, everybody who has their mortgage had to qualify against a 5.25% or 4.79%, depending on when you did it. And they're like, we know we qualified them so that this is within their budget based on their current income, their current spend, like they're at the time, based on their income at the time, their spending at the time, their debt at the time. They can afford this mortgage. If rates were to get as high as 5.25%, it's still going to only be 44% or 39%, 44% of their income, which is well within the affordability range. So really, they can sit there and say, okay, as long as everybody's still spending, we know we have that cushion up to where that 5.25% is before this is more of their income than what we qualified them at. So they kind of can look at that and say, okay, we still have a ways to go before we get there with that overnight lending rate. Because to hit 5.25%, most people have prime -1, prime -0.9, whatever. They're looking at, okay, the overnight lending rate would have to get up as high as 6% before we're in that territory. And I know people don't want to think about that. I'm just saying, you qualified for your mortgage there, so it is affordable. That's within your affordability, based on the debt ratios and everything that we did. So I guess that kind of answers the question with how high can rates go? Well, in the Bank of Canada's mind, they have that area where they can get to the benchmark qualifying rate, knowing that people were qualified against that and that it's affordable for them. Now, what changes that in the individual's budget is if their income is reduced, if their spending habits change, if they take on more other debt. All of that then changes the affordability. But that's not the data that they're working with right now. They're going based off how you qualified. Where that data comes into play is when they take a look at, okay, is consumer debt up? Because right now, at the beginning of this year, consumer debt in Canada was at an all-time low. Are we running the risk of people losing income because of joblessness? Well, right now there's 1 million job listings across Canada. So even if someone were to lose their job, there's lots of jobs out there to be had. So they look at those extenuating factors, and there's not as much risk. We hear all the preaching of a default or, of a bubble or all of these things. But the things that actually contribute to a huge negative downturn are things like joblessness, are things like, defaulting on credit card payments. So people will always default on a credit card payment before they default on their mortgage, right? You'll see, if you have the money, you make sure you pay your mortgage before you make sure you pay your credit card, or your phone bill or things like that. So until they start seeing credit card defaults creeping up, they don't worry about people not having the money. We're still, and they still see inflation going up, which means people are still spending. Um, so that's kind of the mindset of what the Bank of Canada has to work with. They can take a look at the historical data and say, traditionally, when we've seen inflation do this, we raise interest rates and people adjust their spending habits. What they haven't accounted for is the human behavior coming out of a pandemic where people don't want to adjust their spending habits because they've had to go without for so long. So that's kind of gotten us to where we are now. So when people say, what happens if I can't afford my mortgage? That's not real risk actually right now. I mean, I'm not going to say it's not a risk for anyone, obviously. If you've lost your job, if you've had a significant impact on your life that has affected things, sure, there's an element of risk there. But because of that benchmark qualifying rate, you are qualified to absorb some risk. So that's where we are. Now, it leads to some more interesting questions. And I actually was talking with a few different lenders today, and I asked them, if I had a client who wanted to, switch their variable rate to a fixed rate, and that fixed rate was higher than 5.25%, do they have to requalify? And they said no. Which made me think, okay, hold on. So you're allowing people to switch out of a variable rate into a fixed rate mortgage that they may not qualify for, because they qualified at 5.25. They didn't qualify at 5.69, much less the 2% above that. So you're going to allow somebody to switch over to take on a payment that their debt ratios may not allow for them to. If this had been a new mortgage, you would have said, nope, your ratios are too high, you don't qualify. And they're like, well, yeah, we don't have to underwrite it, so yeah. And I'm like, well, doesn't that increase the risk of potential defaults? Like, doesn't that seem risky? And they're like, no, we're not worried about it. And the reason they're not worried about it, and the reason why you might see banks or various different people saying, okay, switch now to fix, switch now to fix, switch now to fix, is because fixed rate is where they make their money. So they'd love to have you locked in at a 5% or higher rate, because they anticipate rates are going to come down in the tail half of the year. They would love to have you locked in there, because when rates do come down, and rates will come down, like, make no mistake about it, this is historically, rates go up and rates come down, so they will come down. But when rates do come down, if you suddenly want to break your mortgage to get into a lower rate, they're now getting a huge penalty from you for doing so. Whereas if you stayed in your variable rate mortgage, it's only 3 months interest, right? So of course they're encouraging people to switch over and lock in, because they anticipate the money they're going to get from that, not just in the higher interest rate, but also in the penalties and things like that down the road. So that's kind of where you have to be really mindful when you start thinking about, should I lock in? I know it feels like right now rates have been a runaway train, and in some ways they have been. They've caught the best economists off guard. Every time I go to a training session or listen to any of the economists, they're like, well, okay, so what we said was going to happen at the end of last year or the beginning of this year, we were wrong. And it's always based on the data, this is what presented. Now we're going to see the spending change. It's everybody's going to have to. I think the other important thing to remember too is, when we're dealing, if you're in a variable rate and you've seen your rate double, because some people have already seen their rates double because they got a 1.35 rate, and rates have gone up more than 1.35%, or they've gone up 1.25, so close to double. By next week, they will have doubled or more, but their payments have actually only gone up about 20%. So that's another key thing to remember. It's just because rates double doesn't mean your payment doubles. So their payments have gone up maybe 20%. And that, again, gets absorbed by that benchmark qualifying rate. That's kind of things in a nutshell with where the economy is and what's happening with rates and why it's happening that way. So now let's take a look at the anxiety that it's causing. And I'm going to kind of step aside from all the the datas and the facts and all of that, and just say, okay, here's a couple things that will help with that. So the first thing is acceptance. Anxiety is usually caused by resistance to change or resistance to what is happening. It's not what you wanted or not how you wanted it to go. And life is full of things not going how you anticipated or how you wanted, no matter how much you plan, no matter how much research you do, no matter how much. So that resistance to the way things are, it's not unlike what we saw at the beginning of COVID with a resistance to things being shut down. I don't want to have to stay home. I don't want to have all these things. So the acceptance of where things are is a key part to alleviating anxiety. Saying, okay, I made this decision along with my mortgage Jedi or mortgage partner. We made a decision based on a plan that we had, and that plan is still sound. It's escalated. Instead of things going up gradually, things went up, and then that potentially sets up the fact that you're going to have a longer time enjoying the coast down. It's actually not unlike what we saw in 2017, 2018. I always remember this, and I shared it. I never share clients' personal or individual data or anything like that, but anecdotally, I will talk about experiences that I've learned from clients. I had two clients right around the same time in 2017, both opt for a variable rate, and the rates started going up. And it was back then. I think rates ended up going up about 1.25% in total over the course of about 9 months to a year. I don't remember the exact numbers. One of my clients said, we're riding this out. And back then, everybody thought, okay, rates are going to get to 5% because that they brought in the benchmark rate. That's where the government anticipates things to be. One of my other clients, when it was near the peak, said, I'm locking into fixed. I'm like, okay. I think you can all guess which of those two clients ended up further ahead now at renewal time, because nobody anticipated a pandemic and the rates dropping. And that's not to say we'll have another pandemic, but there will always be something. There will always be economic flux, right? So that's one thing, is kind of knowing that you had a plan in place and it was a sound plan based on all the data, and you shouldn't just abandon ship just because things happened at a different pace than what you anticipated. The second thing is, remember that what you're looking at, and I know it's a home and it's personal and you have emotional attachment, but what you're looking at is an investment as well. Your home is an investment. For anyone who owns a detached home, or the majority of people in Southwestern Ontario who own detached homes right now, you're going to be millionaires. If not now, you're going to be millionaires in a few years. Like, you have $1 million asset. So when people sit there and say, well, how am I ever supposed to own a home? It's like, well, you know what? Let's be realistic about this. If you want a detached home, that means you need to have the earnings and spending habits and savings of someone who deserves $1 million asset. Like, that's the reality. We are now in a Manhattanization, which means we're seeing a lot of high-rise condos. We're seeing a lot more things like that. And because we're in Canada and North America, where we're a very young country, we resist that mindset. But if you take a look at countries like, if you take a look in Europe and places like that, England, countries that are older and more developed, that's been the status quo for a long, long time. Homes, like detached homes, are shared by families. They're you have multiple generations in there owning it together. You think of some of your favorite sitcoms like, Friends or Seinfeld or How I Met Your Mother or things like that. None of those characters own their home in New York. They all rented apartments, right? And that's the Manhattanization trend that we're now getting to with our population, because we are at that kind of precipice where we are that big. Every majority of Canadians live within an hour of the border, which means we're immensely populated in this area. So to own detached homes may soon require moving out of that area. I'm just looking at something to have a variable rate. Sorry, question from Jeremy here. Have a variable rate. When it goes up, my payment stays the same, but the amount of principal changes. Right. So there's two different types of mortgages there. There's what's called a variable rate and what's called an adjustable rate. Okay, they're two different things. Variable rate mortgages are typically mortgages offered by the big five banks. Okay, it's usually banks that offer variable rate mortgages, and they do exactly what Jeremy's talking about there. When the interest rates go up, your payment stays the same, but the amount that gets paid off your principal drops. Okay, so more of your payment goes towards interest, less goes towards principal. Adjustable rate mortgages, which most of the national monoline lenders and people like that offer, it's the opposite of that. Your payment goes up so that you're still paying down your mortgage the same way you would have from day one. So at the end of your amortization, while you may have paid more in interest, what's left of your principal is still what was initially planned to be left of your principal. Whereas with a variable rate mortgage, your payment doesn't change, but you're going to have a lot more owing on your mortgage at renewal time. And that's another way in which sometimes adjustable rates save you more money in the long run, because it's never about what you pay for your mortgage on one particular month or in one particular year. It's what you pay over the life of your whole mortgage. So whether that's 25 years, 30 years, whatever, it's, you look at what that costs you, and you don't look at what your payments are. You got to look at how much of that is interest, because the interest is what's called the cost of borrowing. The principal is basically forced savings. You get that back when you sell your home. So if you think of it that way, and that's a really key point here. If you take a look at what you pay in interest over the course of your mortgage, and then take a look at how much that asset has gone up in value. I do this report with my clients where we look at their return on investment. So let's say that you're paying, I don't know, $1,200 a month in interest, or we'll say $1,000 to make it easy. So you pay $12,000 a year, but your home's gone up $50,000. Well, you've just paid $12,000 to make $50,000. And obviously lately it's been way more drastic than that. So that's a good return on investment. That's not a return on investment that you see in any other form of, you don't see that in mutual funds or the stock market usually, or things like that, where you get that kind of return on investment. I'm just going to see what the rest of it. So, yeah. So with the type of mortgage that Jeremy's referring to, do you ride it out because your payment stays the same, and it just means you have less paid down, and you hope that at renewal time that the rates are lower at that point, and you can then eat away at the principal more so. For that one in particular, actually the strategy I recommend is you ride it out exactly like you're saying, but keep your eye out for when, and you may need help with this because depending on your lender or your mortgage partner, they may not keep you apprised of this. Variable and adjustable rate mortgages are made up of two parts, right? They're made up of whatever the bank account, like whatever the prime rate is, and that can differ from lender to lender, so keep that in mind. Sometimes we'll see banks have a slightly higher prime rate and then offer a bigger discount, which nets the same. So there's the prime rate, and then there's the discount amount. So you'll see your rate will be prime minus 1% or prime minus 0.9% or prime whatever. So if you have that, and we get to a point of where the discount on your prime rate becomes bigger than what the one you currently have is, then paying that 3-month penalty to get out of it and get the bigger discount oftentimes makes a lot of financial sense. So that's the other thing to watch. If you're sitting in one that's like, recent numbers would be like prime minus, I don't know, say 0.6 or 0.5 or 0.7, and we get to a point of where it's prime -1 again, paying that 3-month penalty and locking in at that prime -1, that's instant guaranteed savings for the rest of your mortgage. So that's a smart move. Sorry, answered Jeremy's thing there, but got a little off where I was going with this. So back to easing the anxiety. So one is, accept where you are, right? Accept the fact that this is the situation and say, okay, now how do we deal with it? Instead of saying, what should I have done? It's what do I do? It's always living in the now and being proactive. And I will still tell each and every one of my clients that the variable rate you were in was the right choice and is the right choice, because this is not something that was going to continue. We knew there was going to be increases. The increases happened rapidly and quicker than we anticipated, but we also knew there would be ebbs and flows. Now we just have to wait for the downturns, and they're going to come sooner than we anticipated, just like the upturns came sooner than we anticipated. People are going to stop spending. People are going to have to stop spending because of all these other extenuating circumstances. The second thing that you can do to really alleviate some of the stress and anxiety is exactly what I talked about when you're looking at your cost of borrowing. Focus on what you're paying in interest and know that, yeah, that's going up. But typically, if that's going up, it's because inflation is high. And when inflation is high, it means the value of your house is up. So that means that you can't have your house go up significantly in value and expect that doesn't come with a cost, if that makes sense. To have your house be up in value means that's going to happen. So this leads us to another concern that people are saying, well, what if my house starts going down in value? Well, then that means that's a sign that the interest rates will likely follow suit, because it means the demand for the housing has calmed down, which means less people are borrowing mortgages, which means the lenders need to make it more attractive for people to borrow mortgages. So that's when you win-win either way. It's either you have an asset going up in value, or you have a lower cost of borrowing, like the two things. And we were in an unusual sweet spot last year where it was low cost of borrowing and really high asset value. So it was kind of a weird situation to be in. So that's the other thing to keep in mind is it's one of those things where, yeah, it's not just about what you're paying out, it's what are you getting in return for that. So don't lose sight of the fact that, yeah, you're paying that money out now, but it's resulting in a large sum of money that's going to be coming back to you at some point in time, whether it's when you sell the home or whatever. At some point in time, that asset gets liquidated. That might be your retirement plan, right? So think of it this way: instead of, when interest rates go up, instead of putting that money into an RRSP, which I don't know if you've been, well, maybe not RSP, but say mutual fund. I don't know if you've been watching the stock market, but anybody who is putting money in a mutual fund right now, I think would rather have their home asset have been putting that money into their home. So instead of putting it into a mutual fund, you're putting it into your home, and that becomes your retirement savings plan, which is a very common thing nowadays, and a smart thing, because it comes with a little bit more stability than what obviously the stock market's offering. Kind of the last thing I want to touch on, and again, unless we get more questions, is the talk of recession and bubbles. So bubble, get that thought out of your mind. We've been hearing talk and headlines of a housing bubble since like 2008, and it never happens, right? Having something come down in value doesn't mean a bubble burst. Let's talk about recession though. Yeah, we are on the verge of a recession. That's not a bad thing. So let me qualify that. Sorry, I just saw a comment from Haley, and that's a great point. I'm gonna touch on that, because that directly ties to the bond rate, directly ties to fixed rate mortgages. the recession that there will be happening, because a recession is a natural downturn in the economy after a large amount of inflation. So if we have a natural downturn in our economy, that's just returning to normal after what we went through. And everybody saw it, everybody knew, prices were going through the roof, things of that nature. It's just a natural return to normal. It's the balance, it's the ebb and flow. Usually a recession is followed with less spending, which is what we're hoping happens because that'll bring interest rates down. Joblessness, which there's not much risk of that happening right now because there's so many jobs. There's over 1 million postings out there. It does mean that people are, it does mean industries feel it, right? Because if people are spending less, it means businesses are making less, and then they might cut hours and things like that, which is interesting because that's what they thought was going to happen as a result of the pandemic. But instead, the government printed a whole bunch more money, and anybody who was out of work got served. And that's what's really, the more money being out there is what caused the inflation. That combined with the excess of spending, more money circulating. So it's one of those things where the recession talk, usually it's an indicator that there's going to be a negative market in terms of stock market. We've already seen that. Anyone who had money in crypto has already seen that. So it's one of those things where we're starting to see signs of it, and it's probably what's needed to give us kind of some overall relief, some overall balance, because inflation was out of control. We saw things were costing so much. Supply chain issues throughout the pandemic led to higher demand, which led to people paying more, those supply chain issues are now gone. The price of oil and gas being so much more causing higher transportation costs, that's starting to ease a little bit. I mean, obviously the war in the Ukraine is having an impact on that, but we're seeing those gas prices come down. So the costs of all of that, will kind of balance out. And then, if we get a little bit of a recession, normally you're not one to say, hey, recession's a good thing, but it's better than what would happen if things continued to trend the way they are right now. So that's kind of what I want you to keep in mind when you hear the term recession. A lot of people think recession as kind of like the Depression, and they're very different. A recession is a normalization in the marketplace. And after what we've just been through, everybody was screaming for, hey, prices can't continue like this with housing. It's impossible. So let's talk a little bit on the downtrend. Haley kind of brought this up, the downtrend in the DJCI and the 10-year bond rate. So the bond market is what actually, and I'm going to touch on this piece as to how it relates to mortgages. So the bond market is what actually dictates fixed rate mortgages. They're tied directly to how the bond market's performing. The bond market was performing ridiculously well in the face of a pandemic. And I think everybody's like, okay. Part of that was that the Bank of Canada held bonds on their balance sheet to try and help the economy. So they were buying, Canadian bonds to try and help the Canadian economy. So what's going to happen is the downtrend in the 10-year bonds, like the Bank of Canada already said, they're not renewing their bonds when they come up for maturity. So they're like, okay, so suddenly there's going to be a downtrend in bonds, and downtrend in bonds is usually followed by a downtrend in fixed rates, which is why converting now is a bad idea. Because if you wait and you really, really, really want to lock into a fixed rate, you're going to find that the fixed rates are going to start dropping because of that bond trend, and you're going to be able to lock in at a lower rate. Like I said earlier, to do it now would be like buying a stock when it's high. So my thoughts on the downtrends, I think I covered most of that by saying it's a natural normalization. The bond market, like everywhere else, was outperforming where it should have been. And this is just a normalization in the ebbs and flows of an economy. And the positives to take away from it are that we're going to see fixed rates come down. And when fixed rates come down, those who really want to lock in have an opportunity to do it at a lower rate. But those who are in variable, inevitably the variable has to be competitive with fixed. So everybody kind of wins from that, except the people who were expecting a higher return on their bonds, I guess. But again, that's taking money out of the marketplace. If inflation is caused by too much money being in the marketplace, then the raising of the interest rates is the way for the government to take some of that back out. By raising interest rates, they're taking some of that money out of circulation, and that's kind of what we're starting to see happen. Is we're seeing money being taken out of circulation, which should stem the inflation. Wow, 45 minutes. That was a lot of rambling for 45 minutes. That's awesome. Haley, I don't know if that answered kind of your question, but I'm trying to keep things kind of more related to how that relates to the mortgage side of things. Anybody else has any questions? I'm happy to answer them. I know we've got a mix of realtors, mortgage people, mortgage holders, all on here. So it's kind of it's kind of an interesting thing. I'm going to kind of put this out there as a couple of things that you're maybe for those who are looking to get into the market, a bit of a mindset shift. And Jeremy or any of the other realtors on here can kind of certainly pipe up on this. But the process for buying a home, I think, has changed from what everybody understood it to be. So the having to go in well over asking price with a 30-day close and no conditions, that's not as much of a thing as what it was, say, 6 months to a year ago. You can now be more meticulous, and I think we are starting to see the transition to a buyer's market versus a seller's market. I don't think we're totally there yet, but we're seeing inventory sit longer. We're seeing the average price come down. We're seeing all the things that signify a bit of a switch. And we saw this same thing happen back in 2017, 2018, where we transitioned from a seller's market in 2016 to a buyer's market in 2018, which meant people were able to buy things at or near asking price, plus or minus a little bit depending on the individual property where it was located. People were able to have inspections done. People were able to have conditions of financing. And I think now more than ever, considering that people have to qualify at 2% above the rate, a condition of financing is crucial. Because an interesting little caveat right now, as we sit here today, anyone with a variable rate mortgage or looking to get a variable rate mortgage, high ratio, so like insured mortgage less than 20% down, qualifies at a 5.25% benchmark rate. As of next Wednesday, that drastically changes because they're going to have to qualify at 2% above the contract rate, which at that point in time, the contract rate, assuming the discount stays at prime minus 0.90, they're going to have to qualify at a much higher amount, which can have up to a $75,000 impact on your affordability, $50,000 impact on your affordability. So anyone who's out there looking now needs to touch base with their Mortgage Jedi or mortgage partner and say, hey, I know you said I qualify for this much, but I'm not going to have an offer in before next Wednesday. So what does that mean for me? Because the last thing you want, and oftentimes lenders are about a month behind when it comes to raising their prime rate, right? So if the Bank of Canada makes the announcement next Wednesday, to raise their prime rate. Lenders won't raise their prime rate till the following month because it's not going to impact all the payments in July. They're going to impact the payments in August. So let's say you have somebody who goes in, qualifies, and then the rate goes up, and the lender goes, hold on a second, this is now your rate, this is now your benchmark rate, you no longer qualify for this, and they've already put in an offer without a condition of financing, or waive their condition of financing, or whatever. So it's imperative that anybody who is looking right now or actively putting offers in right now be qualified at what we anticipate that higher benchmark rate to be, rather than what it currently is, or we're going to have a lot of people losing their deposits and lawsuits and things like that. Jeremy's commenting, timelines have changed on market numbers going up. Drastic thing hasn't changed yet, in his opinion. The mindset is hitting the lottery ticket. Out of market buyers, yeah. So yeah, out of market buyers were certainly a big thing. I think foreign investors, I'm starting to see this, where foreign investors, that 2-year clampdown on foreign investors. So for those of you on here, and I certainly know one person on here, Amanda, who this is very prevalent to. So the government announced a 2-year freeze on foreign investors, which means people from other countries cannot buy properties here for investment properties. That means that myself and my colleagues have to be on high alert for fraud, because what we're starting to see, I've already seen it in a couple of our more junior agents are coming to me with, hey, here's a file, how do we do it? There are people who are working, making suspiciously low money with suspiciously high down payments, and wanting to buy very expensive properties, like a $1 million property when you make $36,000 a year, and you have this huge down payment. And I'm like, well, how did you save that money, right? So you're going to have foreign investors who are going to try to find ways to circumvent the system, which is either hire people at a inflated salary, or put the down payment in their bank account and sit on it for 90 days and things like that. So we're going to have to be really meticulous on that front. That's something that's going to really be interesting to see how that influences the market. And I think you'll be hearing about that a lot more as we go forward. Am I seeing assessments by banks and lenders change? I've heard about this happening again. It happened, we saw it happening in 2017. I'm hearing of it happening again, where basically properties are not appraising at the purchase price value. And yes, that I have heard of that happening. It hasn't happened to any of my clients personally. So that's a conversation that has to be had all the time anyways. Like, that people need to realize, okay, one of the risks is that you may get an appraisal, especially if it's an insured mortgage, and they may not feel like the home is the value you want to pay for it, and so you have to come up with the difference. That should be a conversation that the Mortgage Jedi mortgage partner has with the client prior to the offer being put in, because they should not be putting an offer in without, if they haven't talked to their mortgage person about a specific property and a specific offer, realtors make sure that they do, because things like the property taxes, things like condo fees, things like that, even the location of the property can be something that is known to the mortgage partner, and they can say, hey, just be aware this might be a thing. So that's, is it happening? Yeah, it's happening out there. Why is it happening? Well, because you've seen the data as much as we have, where the last few months the sale prices are trending down. And so what lenders think about and what insurers think about are, simply put, if this person defaults, am I going to get my money back? That's 100% how they think. They're like, if you default, will I get my money back? That's the bottom line. And there's obviously, what's the risk of this person defaulting? But worst case scenario, if you default, will I get my money back? And if an appraiser comes in and says, well, it's not worth $800,000, it's worth $720, then there's some question as to whether or not they'd get their money back, right? So, and that's why that's happening. All right. If there's not any other questions, I'm going to kind of wrap this up. I want to thank everyone for joining me for this. It was kind of my opportunity to say, okay, look, we know there's going to be a big increase next week, and to kind of talk about why it's happening ahead of time, and hopefully stem any panic that you or your clients might have associated with it, or any anxiety that you or your clients have associated with it. I'm going to put a recording of this up on my YouTube page, which will also link to my website page. And of course, it'll always be available on this page, so feel free to share it. I know there was a lot of data there, but it's one of those things where, you know, at least if somebody's taking an hour to watch this, hopefully they'll come away saying, wow, I didn't know that. That's not, you know, my impression from the headlines. That's not whatever. Because, or even the fact that the fact that anybody who's looking right now, if they don't know to go back and say, hey, forget what you qualified for, let's qualify you at what we anticipate is going to be the benchmark rate next week, so that you don't end up, you know, having issues. Things like that are kind of hopefully tools that you take away from this. All right. If there's no other questions, thank you, everyone. I appreciate you joining me, and enjoy the rest of your week, as hot and humid as it is. I don't know if I want to stay up and watch the Jays play tonight, because it's been nothing but torture for me. But I hope you all have a great night.